The US labor market is continuing to show signs of weakness, with both the Non-Farm Payrolls report and the ADP Private Payrolls report showing a decrease in employment. This is the first time these reports have indicated a decrease in jobs since April 2020. Moreover, 787,000 American workers filed initial jobless claims in the week ended January 2nd, which is higher than the worst week of claims during the height of the 2008 global financial crisis. In addition to looking at the most recent employment reports, this video will also provide a brief explainer of what these reports are. The video will include 3 parts. 1. What is NFP and how is it different than ADP? 2. What are initial jobless claimers? 3. What do these reports indicate for the US economy? This video took forever to make, and we would appreciate it if you subscribe to our channel and hit the like button for the YouTube algorithm. Part 1. Non-Farm Payrolls. The Non-Farm Payrolls report, aka NFP report or just NFP, is perhaps the most important data release in the world, and its impacts are felt across many different markets and countries. The NFP report represents the US labor market and it tracks job gains or losses for all paid workers excluding farm employees. The number also excludes private household employees, non-profit employees, and certain government employees. The BLS surveys more than 140,000 businesses to calculate the NFP number. Every month, the BLS releases the Employment Situation Report, which includes the Household Survey and the Establishment Survey. The Household Survey includes the headline unemployment rate and other stats such as employment by race and gender. It is conducted by surveying households, as the name indicates. The Establishment Survey includes the NFP number, which is released monthly by the US Bureau of Labor Statistics. The report is typically released on the first Friday of each month at 8:30 a.m. New York time. The Establishment Survey also provides info about hours worked and average hourly earnings. The report looks across all industry categories of the economy, from leisure and hospitality to private education. The report is conducted by surveying employers. The US economy started off 2020 with 214,000 and 251,000 jobs added in January and February. In March, 1,373,000 jobs were lost, and April saw more than 20 million job losses. In total, more than 22 million jobs were lost in March and April alone. To put that in perspective, non-farm employment fell by about 8.5 million jobs from January 2008 to March 2010 during the height of the global financial crisis. Since the initial drop, 12.3 million jobs have been added, yet the economy would need to add 9.8 million more jobs to recoup all losses made in March and April. The NFP for December showed a seasonally adjusted decrease of 140,000, which is the first decrease since April. In the December report, the largest declines were in leisure and hospitality, minus 498,000 jobs, and private education, minus 63,000 jobs. The largest increases came from professional and business services, plus 161,000, and retail trade, plus 121,000. Despite gains in certain categories, a nearly 10 million job deficit in non-farm employment is far from recovery and is certainly worrying for the US economy, especially since the December report marked the first decrease in employment since April. Now to the ADP report. The ADP National Employment Report, or just ADP report, is very similar to the NFP report, although it is compiled by a private company instead of a government agency. Rather than being compiled by the BLS, the ADP report is created by Automatic Data Processing Incorporated, which is a company that handles payroll for a fifth of US private employment according to Investopedia. ADP uses its payroll data to estimate trends in the labor market, and it partners with Moody's Analytics in order to create its monthly report. The report is released 2 days before the NFP report and often provides a preview to the information that will be included in the NFP report. These two reports are often similar, yet NFP is considered to be more detailed. The ADP report consists of 4 separate releases that include 1. Private payrolls by size of the business: small, mid-sized, and large. 2. The report also breaks down small business and distinguishes between small and very small and between good providing and service providing businesses. 3. Furthermore, the report looks at franchise employment between restaurants, lodging, and real estate. 4. The fourth component of the report breaks down regional changes in employment using 6 states as a proxy. These 6 states are New York, New Jersey, Texas, Florida, Illinois, and California. December's ADP report echoed the NFP report and stated that private sector employment fell by 123,000 jobs on a seasonally adjusted basis. Large firms shed the largest number of jobs with a decrease of 147,000, with small firms shedding 13,000 jobs. Mid-sized firms added 37,000 jobs. Overall, private sector employment fell by 18,000 for the goods-producing sector. This includes 21,000 jobs lost in manufacturing and 3,000 jobs added in construction. Natural resource and mining jobs remained flat with 0 jobs added. The service-providing sector decreased employment by 105,000 jobs. The largest decrease in employment within the services sector came from leisure and hospitality and trade, transportation, and utilities, which lost 58,000 and 50,000 jobs respectively. The largest increases in employment came from professional and business services and education and health, which added 12,000 and 8,000 jobs respectively. The ADP report was a worrying preview of the NFP report. It stated continued weakness in the labor market, particularly in the service-providing sector, which is the backbone of the American economy and has a far larger share of GDP than the manufacturing sector. Unless the service sector starts increasing employment, especially in leisure and hospitality, then the recovery will take longer than expected. Not only has private sector employment slowed, but it actually went negative in December for the first time since April. Part 2. What are initial jobless claims? Initial jobless claims are reported every week by the U.S. Department of Labor alongside continuing jobless claims. Initial jobless claims are filed by workers that are applying to receive state unemployment benefits for the first time. Continuing jobless claims represent workers that have been receiving benefits for at least 1 week, and the DOL continues to count these workers until they find a new job or exhaust their benefits. The DOL collects data from state unemployment benefit programs to create their weekly report. State data is collected because the states, not the federal government, process claims and pay out benefits. The initial jobless claims report is released each Thursday at 8:30 a.m. EST and counts all claims filed in the previous week. Continuing claims for the previous week are released a week after the initial claims report and therefore have less of an impact on markets. Despite the delayed release, continuing claims are still important for analyzing the labor market. Since weekly data is often volatile, analysts will look at 4-week moving averages in claims in order to get a better idea of unemployment in the labor market. Although jobless claims are a great metric for analyzing the labor market, they do not provide a full picture. For example, not all workers are covered by state unemployment insurance. Workers that are not covered include various self-employed individuals and independent contractors such as gig workers. Luckily, the DOL includes these numbers in its weekly release. For the week ended January 2nd, jobless claims totaled 787,000 and the 4-week moving average was 818,750 on a seasonally adjusted basis. According to the DOL report, continuing claims totaled 5,072,000 for the week ending December 26th on a seasonally adjusted basis, with a 4-week moving average of 5,274,750 continuing claims. The DOL stated that a total of 19,176,857 workers were receiving unemployment benefits for the week ended December 26th across all programs. In the same period last year, only 1.8 million were receiving benefits across all programs. A large number of workers not covered by regular state benefits are receiving federal benefits in the Pandemic Unemployment Assistance and Pandemic Emergency UC programs established by the CARES Act. Initial jobless claims alone are a troubling sign of the purported recovery. At the height of the economic fallout in March 2020, there were 6.867 million workers that filed initial jobless claims for the week ended March 28th. To compare, at the height of the GFC, jobless claims peaked at 665,000 back in March 2009. Ironically, the peak in claims during the GFC also occurred in the week ending March 28th. Although claims have fallen dramatically since 6.867 million were filed earlier this year in March, they are leveling off around 800,000 per week. This is concerning considering that claims are leveling off at a number higher than the highest level of claims during the GFC. On the other hand, continuing claims peaked at 6.635 million during the GFC, and today they are leveling off near 5 million, with the total amount of people receiving benefits in all programs at nearly 20 million. Part 3. What it means for the economy. Before summarizing what this labor market weakness means for the economy, we need to discuss seasonal adjustments. The data provided in this video has been seasonally adjusted by the entities that create the reports. Seasonal adjustments are made to smooth the data since seasonality can lead to volatility in the data. Nearly all economic data releases contain seasonal adjustments. With that out of the way, let's take a look at what these recent reports mean for the economy. First of all, the NFP and ADP reports both indicate that the recovery is stalling and actually reversing to the downside. Non-farm employment has increased in every month since April besides the December report, which is the most recent month that has been reported. Based on the NFP report, there are nearly 10 million jobs that need to be added in order for the labour market to make a full recovery. It could take several years for the economy to add back all the lost jobs. For example, it took more than 4 years for non-farm employment to recover during the GFC. Second, initial jobless claims and continuing claims continue to reflect weakness in the economy. For the week ended January 2nd, initial claims totaled 787,000, which is substantial considering claims peaked at 665,000 at the height of the GFC. If claims are leveling off at a number greater than the peak of the GFC, there is still a great deal of recovery that needs to happen in order for the economy to strengthen. Claims would need to drop substantially lower and hold there in order for the economy to truly recover. Although continuing claims are below the peak of the GFC, 5.072 million currently versus 6.635 million in 2009, there are nearly 20 million receiving some form of UI benefit. The 20 million number would need to drop down to 2 million in order to leave the labour market in similar shape that it was in during the start of 2020. Fortunately, the economic fallout of 2020 is far different than what happened in 2009. Already the economy has bounced back quickly, but it remains to be seen whether these rapid gains will continue or level off as they appear to be. Furthermore, Congress has just passed another massive stimulus bill and vaccines are rolling out all over the world, which should both support the recovery. If you would like a detailed overview of the most recent stimulus package, click the link that is appearing on the screen. Thanks for watching the video and we hope you enjoyed this episode. If you would like more content like this each week, make sure to subscribe to our channel and hit the bell icon to be notified of our newest releases. Also make sure to post a comment down below to suggest a topic.